Hey guys, welcome to Yusan. Now in the past video, in the part 2, we discussed about that investments versus savings, power of compounding, and then we talk about the financial goals, how to make them. And in this video, in this part 3, in this video series, we will discuss about that investors age, okay, and asset allocation. It's mean in what age you should invest in where. It is not mandatory that you should follow this rule or this thing, but yes, you should know that at least that consequences that will give you some sort of light or guidance. Now there are no magic trick to find the perfect asset allocation. Perfect asset allocation is not the only one which will make you rich, but rather the one that will fit your profile, right? Now what is asset class? Did you ever hear that? Now asset class means there are investments opportunity that are high risk and there are investments opportunity there is low risk. So each is called asset classes, right? So asset allocation is not a magic trick to find the perfect one. Determine your investment profiles. One of the key factors to determine your investments profile is your age. While it is not the only factor to take into consideration, you can manage your assets allocation according to your age. Younger investor, come to the second part, that younger investor should be better off with a profile learning more stock with greater growth opportunity, right? But an older investor who is not very young, more than 50-60 plus in the age, older investor nearing or already in retirement should prefer a portfolio with a greater percentage of bonds or other fixed income product, because if they lost their money, they have right now they have not capability to earn more or to fight with that sequence. They need a fixed amount, they need secure amount of money. But if you are a younger, you can take risk for getting a growth opportunity, a greater growth opportunity, okay? So that is very important. So with their more reliable revenue statement and a low opportunity of a stock with their associate risk, so that is for a old man. So there are many ways to determine your asset allocation, including several rules of thumb, okay? Several thumb rules is there. One common suggestion is to invest your age is bond. So if you are 40 years old, you may use 40/60 bond per equity, 40 bond per 60 equity allocation at worst. By such investing according to the age, the asset allocation might be slightly more conservative for the under 40 people and slightly more risky than is advisable for those over 60. However, if there was only age to manage, things would be pretty safe. This is far more being that simple. In the fact, age is only a mathematical data that doesn't take into consideration your risk tolerance. You might be young enough to support a big market drop, as you will have time to play with you to gain it back. But if you are about to have a heart attack when the market goes down 5% or down to lost until you retirement, so you have that capability to accept the up and down of the market. So that is your age will tell you. So here is some general advice, not a special advice, but some general advice for the various age group. First, we will classify here 4 categories: from 18 to 35, 35 to 50, 50 to 65, and 66 and above. Now first is 18 to 35, very important. In India, you can start your investment at the age of 18, right? While you should not be having much money at that very period, because you just join you are in a new job, okay, or you have a lots of need to settle up, you need much money and your earning is very low. So there is where you should risk the most, because technically you should not need the money you invest for retirement for a good 30 years. This is the perfect time horizon for an investor. As such, an asset allocation with 90% to 100% is stock would be ideal. So stock is very ideal for those who are in 18 to 35 because they don't need to expect that they want a return of after 30 years old. No, they can fight, right? So stock would be the ideal for them, stock market, BSE, NSE, whatever. But unless you are good at building your own stock portfolio, it is advisable to invest through mutual fund. Okay, if you don't have the knowledge, then go for a. Now you are good at building your own stock portfolio. If you are not, then it is advisable to invest through mutual fund or index ETF. Why should you select such an aggressive asset allocation? Simply because it will be the type of portfolio with the highest expected yield over time. Investing is in bond at such early age will minimize your profit expectancy for nothing. Right? So at this very young age, invest in bond is useless. Now, this is usually the time of your life, okay, to think. Now, this is for those who are above 35 to 50. Those who are having a better job, okay, they are for better salary. At the age of 35 to 50, you are in the most stable position in your life. And your asset allocation of about 75% of equity and 25% of bonds. 75-25. It is try to aim, okay, to get 75% equity and 25% bonds at your age 35 to 50. Now you still can afford a lot of risk and you should not be shy to take them. The 25% in your asset allocation will smooth your investments return during major crises but would not slow down too much. During this period you can start, okay. So now come to the 51 to 65. Those people who are in 51 to 65 during this period is seeing your retirement, right? However, that should not be the reason for you to secure your assets allocation to the maximize either, since you would not be withdrawing much of your investments at the age. You can still handle some market inflation. Going from a growth to a more balanced assets allocation seems logical, and as such 25% of equity and 75% of bond asset allocation approach would allow you to earn some decent investments return while you not suffering too much during market crashes. Okay, now you are more than 66. You will for sure be retired during this period for your life. If you have been investing throughout your whole life, you should be sitting on a soil nest egg. There are no higher returns. There are no reason why you should not now risk in the name of high return. That is useless. In the name of high return, don't take risk. A more secure assets allocation showing 90% to 100% bonds portfolio would be advisable. So 90 to 100% bond, I recommend you, or it is recommended generally that to buy bonds. Okay, bonds are safe. Okay, so very safe, you can do it. Now this is all about that age class. So let me again revise these things. So first is, if you are 18 to 35, okay, so you should 90 to 100% on a stock market, okay, stock portfolio. You can go with mutual funds, index ETF, etc, etc. Now if you are in 35 to 50, then you can go with bonds 25% equity, 75%. 51 to 65, then reverse 50% equity, 75% bonds. Now at the age of 60 or below, more than 60, then go 100% bonds, because bonds are more secure. But if you would like to take risk, then you can go with. Now that is all about that age factor. Now individual category and selection criteria, that is discussable, right? So we should focus on return, liquidity, safety and tax saving. So whether you are a student, salary and government person, professional, trader, housewife, okay, retired person, so we are classified those things for every age group, every field. That if you are a student or salaried person, just student means 18 to 20